Hello and welcome to this Forex Preview at xm.com. I'm Maria Pachordiz, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be discussing the upcoming non-farm payrolls report due out of the U.S. on Friday and the outlook for the dollar. So Rafi, now that virus cases in the U.S. are starting to decline and Americans are receiving stimulus cash from Congress, forecasts predict the NFP report will show a healthy pickup in jobs growth in February. If, however, the numbers disappoint again, what will it mean for markets?
So Maria, that is right. We have seen those stimulus checks coming through, and of course the falling number of cases. All of that means that hiring probably increased in February, and that's good news for the U.S. jobs market because we did see late in 2020 the rebound plateauing, and we had a pretty dismal December and a very soft rebound in January. So forecasts for February are currently running at 182,000 increase in non-farm payrolls. So if that's the case, then we're probably not going to see a huge market reaction. And even if we were to see another disappointing report, that in actual fact might be good for the markets because we are seeing, of course, we've got this sell-off in bond markets, yields are rising, and a strong report would actually push yields up even further. Whereas if we see a poor report, then that would alleviate the pressure on rising yields, and that would lift stocks, and we could see the dollar slipping. So markets would probably be better off seeing maybe an underwhelming report. But if you were to see a very strong report, that's almost certain to fuel the rally in treasury yields.
Okay, now Fed Chief Jerome Powell will speak today at 17:05 GMT. If he uses tougher language about the dangers from rising yields, what reaction are we likely to see in the US dollar?
So there's a lot of speculation about what Powell will say because so far he hasn't indicated that the Fed is too worried about this surge in yields that we're seeing. So there's a lot of speculation that the Fed might try to talk down this rise in yields, try to calm fears about higher inflation and the fact that the Fed might begin to taper its asset purchases sooner than expected. So far, as much as the Fed has tried to reassure investors, it hasn't really succeeded in calming those fears. So Powell might use stronger language today, but what would be a game changer, though, is if Powell was to signal that the Fed is actually willing to alter its asset purchases, perhaps focus more on longer dated treasuries than on shorter dated ones that it currently does. And that would be quite significant because then that would really push down treasury yields, and we could also see a big lift in stock markets, and that would significantly put downward pressure on the US dollar as well. But it's really unclear whether or not Powell would go as far as saying something like that just yet. Powell might just again try to reassure markets that those inflation expectations are overdone. If we see inflation, it's only going to be temporary, and the Fed isn't about to pull the plug on its massive stimulus anytime soon. So we're likely to see quite a lot of volatility, not just in the US dollar, but in stock markets and, of course, in bond markets too.
Rafi, thanks so much. And thanks for joining us at xm.com.